makers and market movers. This is The Pulse with Francine Lacqua.
Fear spreads across global markets on uncertainty around Fed policy, frothy AI valuations, and a sharp sell-off in Bitcoin. Tokyo is working to diffuse tensions with Beijing after the Prime Minister comments on Taiwan triggered a fierce backlash from China. And President Trump welcomed Saudi Crown Prince Mohammed bin Salman to the White House today for talks expected to focus on energy ties, defense cooperation, and AI technology. Now, later this hour, don't miss our conversation with the former Vice President Mike Pence. We, of course, get his thoughts on the U.S. economy, geopolitics, and the current White House. Now, first thing is first, as always, let's check what the markets are doing. Now, there is a retreat going on in the markets. Look, it's gathering some pace across global markets. Now, a lot of stocks are deeper into decline. Bitcoin actually towards the $90,000 mark. Bonds, the biggest beneficiaries as investors seem to be seeking havens. The yield on the 10-year U.S. Treasury, for example, falling 3 basis points. And then if you look at these gross asset moves, look, it's unclear exactly what's underpinning or underscoring them, but there does seem to be a lot of unease over interest rates and tech earnings. Remember, it's Wednesday that Nvidia reports poised to test investor nerves, and then the focus will turn to the delayed September jobs report due on Thursday. That's, of course, a key gauge for the outlook of the Fed. Now, I'm here in Singapore, which is set to host the latest edition of Bloomberg's New Economy Forum. The event, established in 2018 to embrace a historic shift in economic power from west to east and from north to south by bringing together the best of government and private enterprise from across the globe. Well, first, the retreat from risky assets seem to be gathering pace across global markets. We're looking, once again, at Bitcoin reaching that critical trigger point, with investors pulling back from riskier concerns of riskier corners of the market. Joining us now is Mark Cudmore, Bloomberg MLive executive editor. Mark, thank you for joining us. I mean, what a day. It's starting, to feel ugly out there. And now the global sell-off seems to be surpassing some of the technical milestones. Yeah, definitely this morning in Asia, I think you're getting that first kind of hint of panic of this sell-off. This is really the continuation of a pullback that started at the end of October. And I think it was driven by a little bit of worry in the frothiness in the AI bubble and a concern about the amount of capex spending and the debt in the space. And so we've seen kind of people take profit on winners. And what's happened there, the sector that's really suffered is the digital asset space. So we've seen digital asset treasury companies suffer. That's feeding into crypto in a negative spiral. And that's the space where there's still a lot more downside. Because of that damage there, retail investors are getting hurt, and therefore you're seeing some of the favored retail names suffer most. I actually think that because earlier this morning we're seeing that first hint of like people going, oh, this is getting a bit scary, we're probably getting near the end. The last couple of weeks I've argued with more downside. Now I think we're probably starting to get towards the end of this pullback. I think what's really important is the structural backdrop here is we have an AI bubble. We have a massive AI bubble. It's going to burst horrendously. This is not the bursting. We're going to get good Nvidia earnings this week. That's normally a sell the fact event, but it'll emphasize that we're still in the inflation period of this bubble. And so is this pullback over? Probably a bit punchy to say that when almost everything's down right now, but I'd say we're probably pretty close to the end of this this pullback, and we've still got another leg higher in the bubble, definitely. Mark, what's happening with Bitcoin? It seems to be extending its slide.
Yeah, I think so. So I think crypto is the really vulnerable part here, and I think probably particularly Bitcoin, only because the altcoins have already suffered off so much, but I think the digital asset treasury companies are really kind of getting blown up, and people are realizing that while they help the bull market on the way up, they also help the spiral on the way down. The only incentive now for those digital asset treasury companies, as their net asset value falls, as their stock price falls, in fact the logical trade is to start selling down their crypto holdings and buy back stock. That's the logical thing to do. Now they might hold on, but that's just going to increase the pressure even more. So suddenly you've got this overhang of crypto that needs to be sold. So I think Bitcoin we know is constructed for a boom and bust cycle. This may not be the last boom. There may be another big boom ahead. There may be much higher prices, but it's constructed to have kind of 70% corrections, and we're probably in another one right now.
Mark, thank you so much. Mark, a busy man, of course, with everything that's going on in the markets, the live blog. Bloomberg's MLive executive editor, Mark Cudmore. Now let's also bring in Grace Peters, co-head of global investment strategy at JP Morgan Private Bank. Grace, thank you for joining us. What a day to have you on to look at what the markets are doing. Where do you think they're headed next?
Well, what a day to publish our outlook. We've just put out our 2026 outlook called Promise and Pressure, and I think that really encapsulates much of what's going on and what the market's trying to digest. Pressure from AI, the question that you were talking about with Mark there, are we in a bubble? Questions still around the meanings of global fragmentation and inflation as well. But, as the title suggests, we do think promise is going to win out. So our forecasts are that for global equities, we're going to actually see another fourth year of double-digit growth, which is pretty unheard of in more recent times. But it doesn't stop there. Stocks and bonds, we think that there's still promise, but you really need to be expanding into private markets, both to enhance returns and seek out elements of the AI value chain, but also really for diversifiers to really protect the portfolio against some of the pressures that we do see building, because the outlook certainly isn't all rosy.
Grace, I love the name of the outlook because in 3 words you encapsulate everything that's going on in the markets. So your 2026 outlook is investing at the crossroads of AI fragmentation and inflation. Is there too much riding on Nvidia at the moment?
Look, I think that the AI story has certainly, you've seen the value accrue to large cap tech players who have consistently exceeded market expectations when it comes to raising capex, raising earnings, and the market's getting to the point where it's saying, look, this has been so far so good, but there are some signs of a bubble creeping in, particularly when it comes to leverage, some cross-financing deals that have been done. But our view is that AI is going to be utterly transformative. We're still in the earlier innings of that. And yes, there are some amber lights flashing, but I still think there's plenty of investment opportunities. That, to me, does start with the hyperscalers, with large cap technology. But what we say in the outlook is that there are other sectors as part of the AI value chain that tap into the power needs, which are really at an inflection point globally, but particularly in the US, that tap into, at this inflection point of adoption of AI, the winners and losers across various sectors, and as I say, in private markets as well. So we do think that there's a multi-pronged way of investing, and if we're thinking just about public equities, we would be broadening exposures beyond just technology. That is one of our 5 preferred sectors, but also linked to AI, utilities, industrials, and then outside of AI, financials and healthcare, we think are areas of interest. So all that speaks to earnings driving the market to get to that 7,300 price target. We're assuming 11% earnings growth for the S&P over the next 12 months. But that broadening out of earnings growth, so not all the heavy lifting is being done by technology, although that's obviously going to be a significant component of it.
Grace, when you look at AI, how much would it actually change the labor market just in a time when inflation is extremely unpredictable? Inflation is also one of the things that you're really focusing on for your outlook of next year.
Yes, I think AI is going to transform the labour market. I think there's not significant evidence yet coming through in the numbers to say that it's resulting in more layoffs and that it's, really one of the causes of the current labour market weakness. But it's certainly something that we need to watch for going forward. And that could have, obviously, crossroads when it comes to our piece on global fragmentation and how this is really all about security and companies turning inward. So there is a little bit of a trade-off when it comes to some of the immigration policies versus some of the other dynamics in the labour market, including demographics, as well as how AI will impact the labour market. But overall, we think that US growth is going to continue at around 1.5 to 2% in the year ahead. That's going to support a healthy backdrop for investing. A Fed that can cut a couple of times more, which again will support risk assets, and therefore, as I say, the promise, coming through overall. But I'd also mention, just back to some of my opening comments, gold we still think has significant upside when you look to the alternative space. Our price target there, 5,300. So a good amount still to go for, despite what's obviously been a very, very strong 2025 for gold. And the diversifiers, infrastructure, specifically to inflation, Francine, I'm often surprised when I meet clients who are concerned about inflation but don't have enough infrastructure assets. And I think that's a great place to go for income with inflation protection. So adding gold, adding infrastructure, and also macro and relative value hedge funds, I think really just increases portfolio diversification in an uncorrelated way at a point in time where I think global markets are increasingly correlated because of some of these structural themes and the interdependencies that exist around the world.
Grace, when you look at fragmentation and the fact that the world is splitting into different blocks, what does it mean for investors and the deployment of capital?
Yes, I mean, this is really linked to countries looking inward and therefore fiscal activism being very present around the world, no more so than here in Europe with Germany's fiscal package. And so what it means, I think, is that firstly, you will see new avenues of growth come through. Using Germany as an example, I think German GDP could accelerate, probably not in the next 6 months, but looking more to 2026, 2027. And that is going to be a boon, we think, for defence company earnings. And we've heard from some of them this morning talking about positive order books. But when we look at the earnings trajectory of European defence, you could be moving from an era where you've seen over the last 5 years more like 7% compound annual growth rate to more like 15% plus. So certainly opportunity amid fragmentation. But I do think it also means that investors therefore need to be much more globally aware. And it speaks to that diversification point, not just by geography, but also by asset class.
Grace, how delicate is going to be this week, going back to shorter term outlook, because we have that employment data that actually we didn't get for quite some time because of the shutdown, and Nvidia earnings?
Look, I think that there's a couple of very well-watched data points that are coming up this week that will be pivotal for the short-term direction of markets. And I think this all really started, to me, at the beginning of third quarter earnings season, rather than the end that we're going to see soon, where you saw strong earnings beats. This has been one of the strongest earnings season that we've seen in the last few quarters. And yet share prices were not following through. And so that was the early indication that investors were getting nervous. You were getting a bit of travel versus arrive and a bit of profit taking come through. So I think that could continue. A 5 to 8% consolidation in markets at any point in time I see is more healthy. But I think as we move through the balance of this year, the fundamentals will play out. I think once people have got over concerns about the labour market and the Fed, that the environment ahead does look more constructive. And so, we still see an awful lot of cash on the sidelines, and a lot of our focus with clients is really ensuring that they get invested, stay invested, but in this way that we've discussed this morning, that we think can really lead to resilient, long-lasting, compounding portfolios.
Grace, is gold a hedge against everything that could go wrong? It's no longer inflation; it could be fragmentation. It's maybe also, a diversion or diverting some of the U.S. assets away from treasuries and even dollar. And if so, do you have a new target?
We do, and I think to say that one asset is going to solve everything is maybe a stretch, Francine, but I think that we have high conviction in gold moving up through the course of the year. 5,300 is our target, which gives plenty of upside from current levels around 4,000. And there's a few different drivers for that, and many of the more thematic drivers are the ones that you mentioned that are in the outlook around fragmentation, mistrust in institutions, whether that be central banks or indeed policymakers at large. And also capital flows in a world where investors are still very overweight dollars, and many feel less comfortable being in that situation. So I'm talking about large sovereign investors as well as the central banks themselves. So emerging market central banks have been increasing their holdings of gold, but we still think many of them are below 10%, and that would compare maybe to a 15 to 20% allocation that a European central bank would have. So that buying behaviour, we think, is a longer term theme. It's going to continue to underpin prices of gold, and in the meantime also I think retail investors are displaying more interest, as evidenced by ETF buying activity.
Grace, thanks so much. As always, Grace Peters there, co-head of Global Investment Strategy at JP Morgan Private Bank. Now, geopolitics, of course, will be a top issue at the New Economy Forum here. Japan mounting a broad diplomatic effort to ease tensions with China after the Prime Minister linked the Taiwan Strait crisis with the possible deployment of Japanese troops. Well, joining us now is Rosalind Matheson, our Chief Asia Correspondent. Rosalind, thank you so much. And it's so fun to be actually in the studio with you here in Singapore. Will the Japanese Prime Minister retract her comments following China's retaliation?
Well, for now, it doesn't seem so. Japan is saying they have diplomats out to explain and clarify what she was saying, but there's a big difference between explaining and clarifying and retracting. And also, she has an interest as a very new Prime Minister in staking her ground, including with people in Japan and with China. So does she want to retract this? What she's saying is she was talking about a whole lot of different hypothetical situations, and in that she talked about this issue of what becomes an issue of survival for Japan Japan around Taiwan, which would possibly, mean Japan intervening militarily. But she says it was in the realm of a whole lot of other issues that are theoretical, at least for now. So what they're saying is they're trying to clarify the situation. Her comments with China doesn't indicate that she's willing to retract them or apologise. Again, she's got a lot of interests at home in staking her own ground and in showing China also that she's going to be a leader to be reckoned with. And so there's a lot of issues around image and perception that are going on here, at least. But they don't want this spiralling as well. They don't want this turning into a major incident that runs, that starts to really impact business, tourism, and so on. For now, it doesn't seem to be getting there. At some point, could it become that? But obviously, she doesn't want it escalating.
Ross, in other geopolitical news, so the Crown Prince of Saudi Arabia will meet Donald Trump, and then President Trump has approved the sale of F-35s to Saudi Arabia, which is not uncontroversial. So what's the impact of that?
Well, that's right. And of course, remembering F-35s, he promised those in his first administration to the UAE, and the UAE is still waiting for those to come. And there's a long way to go before Saudi Arabia would be possibly getting F-35s, a lot of negotiations, issues around technology transfer and then delivery. So we are talking about something that's possibly many years down the track, if at all, but it allows him to put this in the ether, at least with this meeting that's going to be happening with the Crown Prince. It's also perhaps more emblematic of his broader desire to bring this region in the Middle East back to a focus that he would prefer, which is basically trade and doing business and getting things normalised on that front. At some point, can you get Saudi Arabia to focus back on the idea of normalising an economic relationship, potentially even with Israel? And so the F-35s are probably a bit of a carrot on that front. Realistically, if at all, we're talking many, many years away. Not only because Israel, does prize its own access to the F-35. It'd be quite reluctant to see a country like Saudi Arabia get their hands on it. There's all kind of questions if Saudi Arabia has F-35s, does technology leak from that to another country like China? So very complicated and probably many, many years away.
Ros, thank you so much. Rosalind Matheson there, Bloomberg's chief Asia correspondent, with me here in the Singapore studio. Now, coming up, Deutsche Bank, it continues to fall after revealing new targets, which could prove a high bar to achieve. That's next, and this is Bloomberg. For the conversations that matter, the insights you need, this is The Pulse, and I'm Francine Lacqua here in Singapore. Now, the Dubai Air Show is in full swing, and Emirates President Tim Clark says he'll refrain from an order of Airbus A350,000 aircraft for now, in a blow to the French aerospace giant. Emirates had previously announced that they were placing an order for 65 Boeing aircraft valued at $38 billion. Let's hear from what Tim Clark, the Emirates president, had to say to Guy Johnson.
We're moving at pace. We've ordered more aircraft here. We've got more aircraft coming in. The 350-900 is coming in. We've now got about 65 of those still to come in.
Yep.
The business is expanding. We're very high seat factors. And Dubai is really moving at pace anyway, so that's underpinning a lot of what's going on at the moment.
Front end of the plane, the premium traffic has been the big kind of underpinning of the market over the last few years.
Yeah.
How closely correlated do you think it is, though, to what's happening in the stock market, which is having a little wobble right now, crypto, which is having a little wobble right now?
It's very difficult. All this, the increasing demand of the premium cabins predated all of this. Okay, you could say that with quantitative easy going on at the pace it was, a lot of money was printed, banks are pretty flush, people are making decisions because inflation is kicking and they want to get the value for the money now. It could be something like that. Frankly, I'm not altogether sure. There are so many things going on in the global economy at the moment, both economically, politically, geopolitically. You can never be certain what is happening. What we do know, people are getting on our aeroplanes, not just ours, in the premium cabins. You see a lot of the US carriers now attending to premium products because they seem to have been behind the curve anyway, realising that something has to be done there. So at the moment, it's very good. I can never say, God, that this is going to go on forever. The cyclical nature of the global economy, the kind of upheaval that we get for all sorts of strange reasons, whether it be natural, geopolitical or whatever, you just have to deal with it. But at the moment, the going is strong. for our part of the world. I'm not going to say that it's going to be the same for the US. I know there's a bit of weakness on the North Atlantic at the moment, but we're not seeing that here.
Okay. You've ordered, you were just mentioning what you've ordered at the air show. You've ordered some Boeings. You haven't ordered some Airbus. Is there any Trump effect in there?
Absolutely.
Is he having an impact here?
No, none whatsoever. It hasn't entered the thinking at all.
Right.
This is all about a plan that's been mapped for the next 15 or 16 years. And looking at the assets that are available to us, and the ones, obviously the 7779 is an aircraft that we got really involved in its initial design. We like what we see, and we want more of them. Now, the hiatus that Boeing's been going through for the last few years, I see a light at the end of the tunnel. Green shoots, all the usual cliches that go with this. Actually looks as though it's going to be. And we never had any doubt about what the aeroplane could do for us, particularly as the 380 was going to be going out at the end of the next decade anyway. So buying those aeroplanes was all about what the business needed, rather than anybody telling.
There's no politics.
No policy. The shareholder of the government of Dubai doesn't get involved in anything like that. They just say you must do what is best for the airline. Don't worry about anything else.
So you are different to other carriers in this region who appear to have made orders as a result of...
Okay, look, these things ebb and flow. But as far as Emirates is concerned, we're purists. We follow our model. It's an organic model. And we're very, very focused on what we need to do and what the KPIs are telling us about how we're doing, how well we're doing. We don't really get people telling us, do this, go there, buy that.
Well, the Emirates airline president, Tim Clark, with our very own Guy Johnson. Now, Deutsche Bank is trading lower, was the worst performer on the Stock 600 Banks Index yesterday. Now, this after the German lender unveiled new targets, which may prove a high bar to achieve. Let's bring in Paul Davies, our global banking columnist at Bloomberg Opinion. Paul, I also want to talk about UBS. That's another matter, but let's start with Deutsche Bank. What did we learn?
The targets are quite ambitious. I mean, particularly on the revenue side. I mean, I think all the bank stocks were down yesterday, and German banks in particular, Commerzbank was down quite heavily as well. But I think the concern around Deutsche Bank is that a lot of the gains they need to make are revenue gains rather than cost saves in order to hit their return targets. And to my mind, the second difficulty they have is that a lot of what they're doing is going to rely on some really big technology upgrades and a lot of deployment of AI as well. And some of that remains, really uncertain as to whether it will really work or not. And these big technology upgrades for banks are often very, very difficult too.
Paul, I mean, they also basically, vowed some higher returns and payouts. Do they just need to align themselves with what the rest of the banks are doing?
I mean, the return targets ultimately are pretty decent, and they're not really... they're not that extravagant. It's 13% return on tangible equity at the group level, 14% within the investment bank. That would put them ahead of expectations for BNP and Barclays at the group level, which would be great. A real statement of recovery of Deutsche Bank after the years of trouble that it had. And in the investment bank, it would put it ahead of Barclays and Citi, and almost in line with Bank of America. So, the return targets are pretty decent, even if they don't sound that extravagant. But it's how they get there is the real question.
And Paul, then, this UBS, I was on the plane yesterday. It was a long flight. It was 12 hours. And I kept on thinking, would UBS really move to the U.S.? And this is after the FT also reported that Colm Kelleher, the chairman of UBS, actually spoke to the U.S. Treasury about it.
Yeah, so there's a big game of political regulatory chicken going on here, really. I think the story that emerged yesterday is as much about UBS finding a way to signal to politicians in Switzerland that the US would accept them as a bank. There's still a huge question of how they would actually get there. Moving, under your own steam would be potentially costly and take some time, and be quite uncertain what the bank would look like. And otherwise you have to either be bought or buy something, and both of those are quite difficult potentially as well.
Paul, thank you so much, as ever. Paul Davies, our global banking columnist at Bloomberg Opinion. Coming up, we'll ask the former U.S. Vice President Mike Pence what he makes of the current administration. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Singapore, and these are your top stories. Fear spreads across global markets on uncertainty around Fed policy, frothy AI valuations, and a sharp sell-off in Bitcoin. Tokyo is working to diffuse tensions with Beijing after the Prime Minister Sanai Takashi's comments on Taiwan triggered a fierce backlash from China. And President Trump welcomes the Saudi Crown Prince Mohammed bin Salman to the White House today for talks expected to focus on energy-ties defense cooperation and AI technology. Now, staying with that story, the meeting with MBS comes after President Trump's trip to Riyadh in May and a promise to sell Saudi Arabia American defense. It marks deepening ties between the United States and countries in the Middle East. Let's go straight to London, where opening trade co-anchor Kriti Gupta is with the former U.S. Vice President Mike Pence. Hi, Kriti.
Hi, Francine. It's a pleasure, as you said, to talk about these geopolitical issues. You said I was joined on set here on The Pulse with former Vice President Mike Pence. We thank you so much for your time. Welcome to London.
Thank you. Thanks for having me on.
It's a thrill to have you. Well, as my colleague Francine just said, it's a big day in Washington today. We have Crown Prince Mohammed bin Salman coming and visiting President Donald Trump as well. This is a relationship that's really deepened over the last couple of years, and certainly since his trip to Riyadh in May as well. What do you make of that deepening alliance between the United States and the Middle East? You would think that these are two places that would be in competition when it comes to the oil markets, when it comes to defense. We're seeing the opposite. What do you think?
Well, I think it's important to remember the very first days of our administration. Back in 2017, President Trump's first international trip was to a conference of Arab nations in Riyadh. From very early on, we sensed that it was important to begin not just with Saudi Arabia, but to reach out to Arab countries, even while we stood without apology for our most cherished ally, Israel. I mean, we moved the American embassy to Jerusalem. We recognized the Golan Heights. Many said that would be inconsistent with peace in the region. But what they forgot was that President Trump, in our 4 years together, aggressively reached out to Arab nations at the same time. We isolated Iran, which is a leading state sponsor of terrorism in the region, and at the end of our 4 years, signed the Abraham Accords. And my hope is, as MBS comes to the White House today, that in addition to the other issues that I'm sure will be discussed from the standpoint of AI and energy and others, is I am hopeful the president will engage the Crown Prince very directly on the need for Saudi Arabia to lead other nations into an expansion of the Abraham Accords.
Well, to your point, that's a key pillar of one of the successes in the first administration under Donald Trump. Mm-hmm. You mentioned that key piece of the kind of withstanding support for Israel. Donald Trump talking earlier this week about actually selling F-35 fighter jets to Saudi Arabia. As you know, this has been a contentious issue, especially among several of the Middle Eastern allies there. Do you think this is going to have ripple effects? If you sell F-35 jets to Saudi Arabia, are more other nations going to be knocking at America's door? And is that a good thing?
Well, the F-35 is our most advanced aircraft, stealth technology. And I'm very confident that as the president gives consideration to the sale of F-35s to Saudi Arabia or any other country that will put the interest of America first. It's extremely important in any sale that we ensure that that technology does not make its way into China's hands or into the hands of other adversarial nations. And so I have concerns about the sale of F-35s to Saudi Arabia or any nation that could not assure the United States that technology and the great advancements that we've made with the F-35 don't fall into the hands of nations that are hostile to our interests.
You're not alone in those concerns. Have you seen this before in your time as vice president, the sale of this high technology, one of America's finest, to countries that maybe don't rise to the ranks of some of the other closer allies?
Well, I think one of the things that our administration did in our 4 years was recognize that China is the greatest economic and strategic threat facing the United States. And we imposed historic tariffs on China. We brought China to the table for the Phase 1 trade deal, which you may remember from January of 2020. But I have concerns that with the administration allowing TikTok to continue to operate, despite the fact that Congress and the previous administration passed a law saying it must be sold or banned within a set period of time. And the recent arrangement to allow Nvidia to sell significant chip technology to China just simply in exchange for a revenue sharing agreement with the United States. I think it's absolutely essential that we continue to put the security of the United States and our ability to defend our interests and our treaty allies across the region as China continues its military provocations and its extraordinary investments in its own military technology. And that would be my concern with any weapons sale to any country around the world.
Well, Vice President, let's continue our tour around the world and talk there about China and the relationship, the deepening relationship, it seems, with not only Russia, but India as well. Earlier this year, we had images of Vladimir Putin, Narendra Modi, and Xi Jinping arm in arm at the Shanghai Cooperation Organization. I was in Washington at the time, and they really caused shockwaves in terms of this axis that you are seeing on the other side of the ocean, on the other side of the Pacific. Do you feel like those images, as they were interpreted at the time, showed that the United States is losing its dominance on the world stage?
Well, I think there's no question that nature abhors a vacuum, and that's equally true on the world stage. The previous administration, in so many ways, projected weakness on the world stage. The disastrous withdrawal from Afghanistan. The Biden administration actually, after inflation, actually cut military spending in the United States. And particularly after Afghanistan, we saw Russia launch its brutal and unprovoked invasion into Ukraine. We saw Hamas surge across the borders of Gaza with the most brutal assault on the Jewish people since the Holocaust. And we've seen China continue its military provocations across the Asia Pacific. When we were in office, we spoke about what the new Trump administration speaks about, and that is peace through strength. And I think the relationship between the United States and our allies across the free world has never been more important. And trade is a part of that. I would hasten to add that I believe in free trade with free nations. And the president's unilateral tariffs imposed on friend and foe alike, I think have been contrary to the long-term interests and prosperity of the West. We ought to be working always to lower trade barriers and lower non-tariff barriers and subsidies. That's what we did during our 4 years. We used tariffs and the threat of tariffs to negotiate, to open markets. But what we're seeing in this new Trump administration is the use of broad-based tariffs that I think ultimately harm U.S. consumers, harm growth, but also more profoundly, they really threaten to fray long-standing relationships in the free world at just the time that we need them stronger than ever before.
Well, Vice President, they're also being used as a mechanism not only to encourage free trade, but also to add pressure on countries like India, like Brazil, that are perhaps helping and fueling some of the goals in China and Russia as well, especially when it comes to the United States' relationship in defending or at least helping support the fight for or the war, the Ukrainians' efforts in against the war from Russia. Talk to us a little bit about that relationship and that dynamic when it comes to the European Union and the UK as well. Historically, Europe and the United States have been arm in arm, but when it has come to this conflict, at least in the second Trump administration, we do seem to be seeing wobbles in that steadfast defense. Donald Trump has, on the campaign trail, and of course in this year, promised and assured the global community there would not only be a ceasefire, but a lasting agreement based on his friendship with Vladimir Putin. Why has that not come to fruition in your minds?
Well, well, first off, I've been a steadfast supporter of U.S. military assistance to Ukraine. I mean, Russia's unprovoked invasion has cost hundreds of thousands of lives. And America's the leader of the free world. And it's absolutely essential that we continue to uphold the principle that we will not allow authoritarian regimes to redraw international lines by force. A century ago, we looked the other way as authoritarian regimes marched across Europe, and the world inherited the whirlwind and the tragedy of World War II. And so I think it's important the United States continue to stay firm. I'm pleased that the Trump administration has gotten to a better place after, as you said, stops and starts on support for Ukraine. But I do think the time has come for the United States Senate to put strong secondary sanctions on President Trump's desk, sanctions on countries that are purchasing energy from Russia, that are literally, through those purchases, they're fueling the Russian war machine. I called on that this summer, and frankly, I was encouraged that just a few days ago, President Trump said that he was okay with the secondary sanctions bill Senator Lindsey Graham authored. I think Vladimir Putin will not stop until he is stopped.
Yeah.
The Ukrainian military has fought bravely. The European community, with strong leadership from the UK and America, have provided support. But at the end of the day, I think isolating Russia economically with those secondary sanctions could well be the key to moving us toward a peaceful settlement.
Yeah.
And a just and lasting peace.
Vice President, you talk about these secondary sanctions. Europe, the EU, has only recently put sanctions on Russia. There's still parts of the EU that are importing that kind of energy. Does America need Europe to hold Russia accountable? Can America go at it alone? That's the narrative that Donald Trump has taken when it comes to his negotiations at the Munich Security Conference, at NATO. Can America do it alone?
Well, in my first trip to Europe in 2017 as vice president, I said America first does not mean America alone. It simply means America embracing our first obligations at home, and secondly, embracing our role as leader of the free world. And I believe during our 4 years, we actually strengthened our alliances across NATO. Before we left office at the end of 4 years, our NATO allies were investing $140 billion in our common defense that had not been invested before.
Yeah.
More than two-thirds were now living up to the commitment we've made to our common defense. I think the ability the European community has had to support Ukraine against this Russian invasion was greatly enhanced by those years that we strengthened NATO. But look, at a time that we see authoritarian regimes rising and increasing their provocations, whether it be Russia or whether it be China or Iran, as they languish quietly after America taking down their nuclear program and Israel taking the fight directly to them. I think now more than ever we need to bring together the free world, say that we're going to stand for our principles, defend our interests, and we'll continue to call for that.
All right. Vice President Mike Pence, we thank you so much for your time. A true tour around the world. That, of course, Francine, was the former Vice President of the United States, Mike Pence, joining me right here in London.
What a great conversation between the Vice President and Kriti. Now, coming up at 91 is, of course, stepping up its push into China and the Gulf. We'll speak to the asset management firm's chief executive live from Joburg. That's next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua in Singapore. Now, South Africa asset management firm 91 is accelerating its expansion into China and the Gulf as it chases a rebound in emerging market inflows. Now, the move highlights 91's aim to grow beyond its South African base and compete more aggressively on the global stage. For more, let's get straight to Jennifer Zabazaja, who's at the Bloomberg Business Summit in Johannesburg with the company's chief executive. Hi, Jen.
Yeah, hi, Fran. Thanks so much. I am sitting next to Hendrik Toit. Hendrik, thank you so much for being here at the inaugural Bloomberg Africa Business Summit. Fran was just speaking to some of the expansion plans that 91 has outside of the African continent. But I wonder if you can give us some insight into the strategy. What markets are you targeting, and how are you thinking about investment plans in this uncertain environment?
Good morning, Jennifer. It's great to be in Johannesburg when G20 is here, even though all the heads of state aren't. What's really important for us right now is we sense a readjustment, a recalibration of risks, and we're seeing international capital, particularly from the developed markets, showing a renewed interest in the rest of the globe, particularly the emerging markets. And 91 is positioning itself to continue to be a leader in that space. And hopefully we are in a far better position than we were the last 3 or 4 years when the US sucked in most capital.
What does that look like over the next few months, though? Do you continue to see more tailwinds potentially for increased investment into EM and outflows potentially out of the US?
I mean, the last few days, the markets have been risk off. We don't think in days, we think in terms of years. And what we see is we're reaching a point where the dollar or where dollar owners are looking for some diversification, where US investors have started looking internationally, and we know more than half the world's capital, in fact 60 or so % of financial capital is in North America, is starting to look outward, and where we've seen some upgrades like this recent South African and Nigerian credit upgrade of emerging market risk. And therefore we'll see some flows going to the rest of the world, which, and look at market performances. Year to date, emerging markets have basically done better than developed markets. South Africa has been a star performer, China has done pretty well, and we think that momentum can continue.
What is needed, though, to accelerate some of the growth in some of these economies? Because there still seems to be a bit of hesitation in terms of the growth prospects for some of these economies, South Africa included. What would you say?
I think it's a number of things, starting with the tariffs. Tariffs created massive uncertainty. I think we're getting towards the end of that, where we will settle down, and therefore corporates and investors can calibrate properly. Then we have had pretty solid macro-prudential performance from many of the emerging markets. That will be recognized. The question is, can the actual bottlenecks and the industrial policies come through properly? And the governance, there are many governance questions around emerging markets, particularly around, South Africa, for example, until recently has been on the grey list for FATF. They have recommended it to come off, but the proof of the pudding is in the eating, and investors are cynical.
When do we start to see it reflected then in some of these markets? You were mentioning the JSE has done quite well. We've seen other currencies across the continent stabilize a bit. Are you expecting potentially the markets to react a bit more once things settle, as you were just referring to there?
I think those who behave appropriately will be rewarded. If you look at what happened in the Gulf, a country like the UAE has completely transformed itself way beyond the oil wealth it has in terms of just creating a sophisticated services economy, attracting wealth owners from around the world, attracting businesses, embracing the technology opportunity that AI gives. And I think, other emerging markets have to follow suit, and, there's opportunity, but in the end, we are bottom-up investors. We look at how individual companies do in specific countries and regions rather than making big macro calls, which often leads to disappointment.
Are you seeing an AI potential that looks attractive to you right now?
I see a huge potential in terms of leapfrogging, as we've done in Africa with mobile phones. Mobile telephony has leapfrogged. It's created financial access. If the exciting Mission 300 of the World Bank and African Development Bank works, and you bring 300 people more onto the grid, you could change education through AI in an entirely different, you could change medical provision, and that will lead to productivity. And ultimately, this is a young continent which has enormous potential and which will attract investment capital if it creates the conditions.
So what are some of those companies? Where in the AI trade are you looking at right now? What's interesting you?
I clearly have been for a while. I don't believe in the AI bubble, but I believe in the power that the AI bubble can can unleash in the world economy. So it's the derivative of AI that's interesting. It's the companies that use technology well. I mean, in the last year, Africa has created 4 or 5 unicorns. Time Bank is one of the first truly digital banks in the world, and it's growing like wildfire in Asia, but it's going to grow here. So I see the educational opportunity in AI as absolutely game-changing. So, and there are a number of these businesses, and right around us listed in this market, firms like Capitec, which are fully digitized, will continue to do exceptionally well.
Hendrik du Toit, it's always a pleasure to speak with you. Thank you so much. 91 CEO joining us here at the Africa Business Summit. Fran?
Jen, thank you so much. Jennifer Zabazaja speaking to Hendrik du Toit. Now, we, of course, have plenty more from the Bloomberg Africa Business Summit today, including an exclusive interview with the South Africa Finance Minister. That's at 11 a.m. UK time. Then Nvidia earnings tomorrow will test investor nerves ahead of the delayed U.S. jobs report due on Thursday. The Fed Governor Chris Waller says current data supports a rate cut next month.
This reading of the data leads me at this moment to support a cut in the FOMC's policy rate at our next meeting on December 9 and 10 as a matter of risk management.
Let's bring in Tom Orlik, chief economist at Bloomberg Economics, who's here with me in Singapore for the New Economy Forum. So shorter term, Tom, thank you so much for being here. But shorter term, could we really have some surprises because we just didn't get data for weeks because of the U.S. government shutdown?
So I think there's a couple of things, Francine. So the first is the view on the US labour market has really shifted with the BLS revisions. A few months ago, it looked like a US labour market which was creating a healthy 100,000 plus jobs a month. Post revisions, it really looks like a labour market that's stalled out. And that's why Waller and other doves on the FOMC are making a case for a December cut. The other factor which you flag is, well, we've just been through a government shutdown. That has a direct negative impact on growth in the current quarter. Government workers not getting paid. But it also introduces this uncertainty. What is going on with jobs? What is going on with inflation? We've been flying blind. It's entirely possible that in some of those delayed releases, there's some information which is going to tip the balance of what looks like a bit of a nail-biter decision with both the hawks and the doves pretty vociferous.
I know we're close to that time of year where you put out your outlook for 2026. I mean, given all of what we've lived through, you know, it's fragmentation, inflation, AI bubble bursting or not, what will you focus on?
So I think these are some of the big themes that are going to be coming up at the New Economy Forum here in Singapore Wednesday, Thursday, Friday of this week. For me, the twin themes of 2025 have been tariffs and AI. Tariffs, if you remember back on April the 2nd, Liberation Day, it felt like the world was ending, right? The free trade order crashing down around our ears, markets falling. Well, a few months on from that, it feels like maybe that reaction on April the 2nd was overdone. Certainly the US economy isn't collapsing, inflation isn't spiraling higher. AI, on the other hand, well, AI both on the technology but even more on the market side has been really a story of enormous optimism this year. 2026, I think we could see both of those narratives starting to shift. I think there's a delayed impact from tariffs which is still to come. Companies haven't started passing on tariff costs to consumers much yet. If that starts happening in 2026, that could be a trigger for consumers to pull back, for a step down in US growth. As for AI, well, I think we're already seeing some pretty significant nervousness in the market about stretched valuations. So it could be that we see a transition from a really bullish 2025, where tariffs were the dog that didn't bark, and AI was a market champion, to a 2026, where we see the delayed impact of tariffs starting to hit the US economy, pulling down growth, pushing up inflation, and some of that irrational exuberance on AI starting to fade away.
Tom, thank you so much, as ever. Tom Orlik, their chief economist at Bloomberg Economics. Now, of course, our coverage from the New Economy Forum begins tomorrow. Top guests, including George Elahedri, the HSBC chief executive, and Mark Rowan, the Apollo chief executive. Up next, it's Bloomberg Brief. This is Bloomberg.